Do you know what this symbol means? Probably yes. But do you know who actually controls it? The US dollar isn't just American currency, it's the foundation of global finance. It's used in oil deals in the Middle East, grain trades in Europe, debt payments in Africa, and reserve vaults in Asia. Over 60% of global foreign exchange reserves are held in dollars. Nearly 90% of all currency trades involve the dollar. The world runs on this currency, but who decides how much exists, what it's worth, and how it moves? That's a more complicated question than you might think. There's no single person, no secret room, no hidden cabal. Instead, control over the dollar is distributed across institutions, policies, markets, and global systems that most people never think about. And understanding this system means understanding how power itself works in the modern world. So who really controls the dollar? Let's find out. Money is power. That's not a metaphor. It's economics. And the US dollar holds more power than any other currency in history. When Saudi Arabia sells oil to China, the transaction happens in dollars. When a Japanese pension fund invests overseas, it converts yen to dollars first. When Argentina faces economic crisis, its leaders scramble to secure dollars. The dollar is the global reserve currency. That means it's the primary medium for international trade, the anchor for other currencies, and the safest asset in uncertain times. Here's what that looks like in practice. According to the International Monetary Fund, central banks around the world hold about $12 trillion in foreign exchange reserves. Of that, roughly $7 trillion is in US dollars. The euro is second, but holds only about $2.5 trillion. No other currency comes close. This isn't just preference, it's structural. Global systems are built around the dollar. Oil is priced in dollars. Major commodities are traded in dollars. International debt is often denominated in dollars. If you want to participate in the global economy, you need dollars. And that gives whoever controls the dollar extraordinary influence. They can affect inflation in other countries. They can make borrowing cheaper or more expensive worldwide. They can freeze assets, cut off access to financial systems, and shift the flow of capital across continents. Understanding who wields this power means understanding the architecture of global finance itself. The dollar wasn't always this powerful. A century ago, the British pound was the world's reserve currency. But 2 world wars shattered Europe's economies and left the United States as the dominant industrial and military power. In 1944, representatives from 44 nations gathered in Bretton Woods, New Hampshire. Their goal was to create a stable international monetary system. What emerged was a framework that placed the dollar at the center. Under the Bretton Woods system, the dollar was pegged to gold at $35 per ounce. Other currencies were pegged to the dollar. This meant the dollar was as good as gold, backed by the largest gold reserves in the world, held by the United States. The system worked for decades. American economic strength, political stability, and military dominance reinforced global trust in the currency. But by the late 1960s, cracks began to show. The US was running budget deficits, partly due to the Vietnam War and social programs. Foreign governments started exchanging dollars for gold, draining American reserves. In 1971, President Richard Nixon ended the dollar's convertibility to gold. The Bretton Woods system collapsed. The dollar became a fiat currency, meaning its value was no longer tied to a physical commodity. It was backed instead by trust in the US government and economy. This could have been disastrous. Instead, the dollar became even more entrenched. How? Through oil. In the 1970s, the United States struck agreements with Saudi Arabia and other major oil producers. They would price oil in dollars and recycle their revenues into U.S. Treasury bonds. In exchange, the U.S. provided military protection and political support. This created the petrodollar system. Every country that needed oil now needed dollars. Demand for the currency remained high, even without gold backing it. The petrodollar system locked in dollar dominance. It tied global energy markets to American currency, and it meant that control over the dollar was also control over a critical piece of the global economy. So who decides how many dollars exist? That's where the Federal Reserve comes in. The Federal Reserve, often called the Fed, is the central bank of the United States. It was created in 1913 after a series of banking panics convinced lawmakers that the country needed a more stable financial system. The Fed's mandate is to promote maximum employment, stable prices, and moderate long-term interest rates. Here's how it works. The Fed doesn't print physical cash and hand it out. Instead, it controls the money supply through monetary policy. Its main tools are interest rates and open market operations. When the Fed wants to increase the money supply, it lowers interest rates, making borrowing cheaper. Businesses and consumers take out loans, and new money enters circulation. When it wants to reduce the money supply, it raises rates, making borrowing more expensive. But the Fed has another, more powerful tool: quantitative easing. This is when the Fed buys financial assets, usually government bonds, from banks and other institutions. It pays for these purchases by creating new money electronically. This increases the money supply directly and pushes interest rates down further. Between 2008 and 2014, the Fed purchased over $3.5 trillion in assets to stabilize the economy after the financial crisis. It did the same thing during the COVID-19 pandemic, purchasing trillions more. These actions have global consequences. When the Fed creates dollars, it affects exchange rates, commodity prices, and capital flows worldwide. Emerging markets see investment flood in when rates are low and flee when rates rise. Asset prices, from stocks to real estate, respond to Fed policy. The Fed's decisions ripple through every economy on Earth. The Fed is technically independent. It's not a government agency in the traditional sense. Its governors are appointed by the President and confirmed by the Senate, but they serve long terms and are insulated from direct political pressure. The Fed doesn't take orders from the White House or Congress. But independence doesn't mean isolation. The Fed operates within a political and economic system, and its actions are deeply connected to government policy. The Federal Reserve controls the supply of money, but the U.S. government controls demand for it. How? Through spending, taxation, and debt. When the government spends more than it collects in taxes, it runs a deficit. To cover that deficit, the Treasury Department issues bonds. These bonds are sold to investors, including foreign governments, pension funds, and the Federal Reserve itself. This creates a cycle. The government borrows by issuing debt. The Fed buys some of that debt, creating new money in the process. That money flows into the economy, funding everything from infrastructure to military operations. The government's ability to borrow in its own currency at low interest rates is a unique privilege. It's called the exorbitant privilege of holding the world's reserve currency. This relationship between the Fed and the Treasury is critical. The Fed sets monetary policy. The Treasury sets fiscal policy. They're supposed to be independent, but they work in tandem. When the government spends heavily, it can create inflationary pressure. The Fed may respond by raising rates. But if the government continues borrowing, the Fed's tools become less effective. This dynamic has played out repeatedly, especially during crises. The government also wields dollar control in another way: sanctions. Because the dollar dominates global trade and finance, the U.S. can cut countries or individuals off from the dollar-based financial system. Iran, North Korea, Russia, and Venezuela have all faced such measures. These sanctions work because banks and companies worldwide need access to dollars and U.S. financial infrastructure. Defying sanctions means losing that access. This is geopolitical power at its most direct. Control over the dollar doesn't just come from domestic institutions, it also comes from global demand. And that demand is enormous. Foreign governments and central banks hold trillions in U.S. Treasury securities. China holds over $800 billion. Japan holds over $1 trillion. These holdings aren't just investments, they're strategic reserves, insurance against financial instability, and tools for managing exchange rates. Why do countries hold so many dollars? First, trust. The U.S. has never defaulted on its debt. Treasury bonds are considered the safest assets in the world. Second, liquidity. The market for U.S. government debt is the largest and most liquid in the world. You can buy or sell billions of dollars worth of bonds quickly without moving prices much. Third, trade. If you're running a trade surplus with the U.S. or pricing exports in dollars, you accumulate dollars. You need somewhere to park them. Treasuries are the obvious choice. This global demand reinforces dollar dominance. It keeps interest rates low for the U.S. government. It funds American deficits. And it gives the U.S. leverage over other economies. When the Fed raises rates, it makes dollar-denominated debt more expensive for everyone. Emerging markets with dollar debts face higher borrowing costs, capital flight, and currency depreciation. The Fed doesn't target foreign economies, but its policies affect them anyway. The energy markets play a huge role here too. Oil is still priced primarily in dollars. Countries that import oil need dollars to pay for it. Even if they're buying from a non-American producer, the transaction often happens in dollars. This sustained demand props up the currency's value and keeps it central to global commerce. Dollars don't just sit in vaults, they move. Every day, trillions of dollars flow through the global financial system. That system is controlled by banks, payment networks, and clearing institutions. These are the invisible pipes that make the dollar economy work. At the center is the Society for Worldwide Interbank Financial Telecommunication, or SWIFT. SWIFT is a messaging network that banks use to send payment instructions across borders. It's not a bank itself, but it's essential infrastructure. If you want to send dollars from New York to Tokyo, your bank uses SWIFT to communicate with the recipient's bank. Almost every major financial institution in the world is connected to SWIFT. But here's the thing. SWIFT is based in Belgium, but it operates under significant U.S. influence. Why? Because most international transactions involve dollars, and those transactions ultimately clear through American banks. If the U.S. government wants to cut someone off from the dollar system, it can pressure SWIFT to disconnect them. That's what happened to Iranian banks in 2012 and Russian banks in 2022. Then there are the big banks. J.P. Morgan Chase, Bank of America, Citigroup, and others act as intermediaries for dollar transactions. They hold accounts for foreign banks, process payments, and provide credit. Their infrastructure is the backbone of global finance. And because they're U.S. institutions, they're subject to U.S. law and regulation. This gives the U.S. government indirect control over a huge portion of the world's financial flows. Settlement systems like Fedwire and the Clearinghouse Interbank Payment System, or CHIPS, handle the actual movement of dollars. Fedwire is run by the Federal Reserve. CHIPS is run by private banks, but overseen by regulators. These systems process trillions of dollars in transactions every single day. Without them, international trade and finance would grind to a halt. This infrastructure isn't neutral. It's built around the dollar, centered in the United States, and subject to American legal and political authority. That's another layer of control. But nothing lasts forever. Some countries are actively trying to reduce their dependence on the dollar. China has been promoting the yuan as an alternative for trade and reserves. It's established currency swap agreements with dozens of countries, allowing them to trade in yuan instead of dollars. Russia has been dumping dollar reserves and increasing its holdings of gold and euros. The European Union has pushed for greater use of the euro in global transactions. There's also the rise of digital currencies. Central bank digital currencies, or CBDCs, are being explored by countries around the world. China has already launched a digital yuan. The idea is to create a programmable, state-controlled currency that can bypass traditional banking systems. If widely adopted, CBDCs could reduce the need for dollar-based transactions. Cryptocurrencies like Bitcoin offer another challenge, though a different kind. They are decentralized, not controlled by any government, and exist outside traditional financial systems. Some advocates see them as a way to escape dollar dominance. But in practice, crypto markets are still heavily tied to dollars. Most trading happens in dollar pairs, and regulatory frameworks are being developed that could bring crypto under state control. Despite these challenges, replacing the dollar is extremely difficult. It's not just about having an alternative currency. It's about trust, liquidity, and network effects. The dollar is trusted because the U.S. has a long history of political stability, rule of law, and economic strength. It's liquid because markets are deep and institutions are robust. And it benefits from network effects. The more people use dollars, the more useful they become. Other currencies lack these advantages. The euro is fragmented across 20 countries with different fiscal policies. The yuan is controlled by an opaque, authoritarian government with capital controls. Gold is hard to transact with digitally. Bitcoin is volatile and lacks institutional backing. None of these can currently match the dollar's dominance. So who controls the dollar? The answer is, it's a system. The Federal Reserve controls the supply through monetary policy. The U.S. government shapes demand through fiscal policy, debt issuance, and geopolitical power. Global markets and foreign governments reinforce dollar dominance through trade, reserves, and financial infrastructure. Banks and payment systems move dollars and enforce access. No single person or institution owns the dollar, but control is distributed across this network of power. And that network is centered in the United States. The Fed sets the price of money. The Treasury funds the government. The banks process transactions. The military protects global trade routes. The legal system enforces contracts and sanctions. This isn't a conspiracy. It's structural power. And it works because the system is self-reinforcing. Dollar dominance creates demand for dollars, which creates reliance on American institutions, which strengthens American influence, which maintains dollar dominance. But structural power can shift. History shows that reserve currencies rise and fall. The Spanish real, the Dutch guilder, the British pound, all dominated global finance in their time. All were eventually replaced. The dollar has been dominant for 80 years. That's a long time. But it's not guaranteed to last forever. The question isn't whether the system will change, it's when and what will replace it. And the answer to that question will determine who holds power in the global economy for the next century. The dollar is more than currency. It's infrastructure. It's policy. It's geopolitical leverage. It's controlled not by a single authority, but by a complex system of institutions, markets, and global arrangements that reinforce American economic dominance. Understanding who controls the dollar means understanding how modern power works. It's not always visible. It's not always direct. But it shapes everything from inflation in Argentina to interest rates in Germany to trade flows in Asia. The dollar's dominance reflects a deeper truth. Control over money is control over the future. And as long as the world runs on dollars, that control remains firmly in American hands. For now.